Good day and a warm welcome to Market Views, a show that breaks down what's happening in Zimbabwe's capital markets, the numbers, the trends, and what they mean for you. I'm your host, Kudakwash Taimo. I'm excited to kickstart with a market review for the week ending 10 October, and perhaps just to add a juice, we'll also look at the monthly review, the month of September, and also look at how the heavyweights have performed for the third quarter ending September. Right, let's dive into it, shall we? For the week ending 10 October, all indices on the ZSE closed in the red, except for the ZSE Medium Cap Index, while the VFX recorded further gains, with only Edgar's closing in the red. The ZSE All-Share Index eased by 4%. Market activity surged, with weekly turnover increasing to 102 million ZiG from 59 million ZiG recorded in the previous week. For the month of September, turnover fell to 454 million ZiG, down from 721 million ZiG, which was recorded in August. Delta was the most traded counter, accounting to around 220 million ZiG, which is 48% of the monthly turnover, followed by Econet with 181 million ZiG, which was 40% of the monthly turnover as well, making both of the two constituting nearly half of September's market traded value. This marked the reversal from August, when Econet and Delta led with 488 million and 153 million ZiG respectively. On the VFX, the All-Share Index gained by 6%. Turnover declined by 49% to 1.5 million from 2.8 million. Looking at the 6% gain over the week, this was riding on September's momentum. We saw the upward momentum in September of 21% surge in market cap, building on 3% gain which was registered in August, as well as July's strong 15% advance, an uptrend that we witnessed in the third quarter right there. Now, just looking at some of the other macros that had a direct impact on the equities, we saw the interbank rate easing by 53 basis points, whilst the parallel market premium remained fairly stable. Delta topped the turnover chart at 73 million ZiG, followed by Econet at 19 million ZiG, mirroring September's trend, when Delta led at 220 million ZiG and Econet stood at 181 million ZiG, like I alluded previously. On the VFX, trading was dominated by Insco and Padenga, with transactions amounting to 921,000 and 305,000 respectively. And looking on a month-to-month perspective, Insco, FCB, and Padenga led in terms of market activity, with transactions amounting to 5.8 million, 946,000, and 863,000 respectively. All these counters recorded gains over the month of September and the week ending 10 October. On the ZSE, foreign sales picked up from 573,000 ZiG to 32 million ZiG, while foreign purchases increased to 11 million ZiG from only 6,000 ZiG in the previous week. Meanwhile, on the VFX, no foreign purchases were recorded over the week. Instead, foreign sales surged to 771,000 from 216,000. Over the month of September, on the ZSE, both the foreign purchases and foreign sales declined from 38 million ZiG and 104 million ZiG respectively to 1.2 million ZiG and 95 million ZiG. But on the VFX, foreign purchases also declined from 26,000 to 10,000, and foreign sales surged from 183,000 to 4.1 million, signifying perhaps investors securing their capital gains, as there has been an uptrend on the third quarter. On the ZSE, only 7 counters closed in the green against 20 laggards for the week. Tenno emerged as the week's top performer, while Citco registered the steepest loss. The VFX posted 10 gainers against 1 loser, which is just Edgar's for the week. And for the month, we saw the VFX also posting 11 counters in the green and only 2 in the red. FCB led the movers, gaining 29% in capital gains, as you can see clearly right there on the chart, trailed by Padenga and other blue chips right there. Now, let's look at our heavyweights and the blue chips just for the quarter ending September and see what was the price action for some of those counters. Looking at Insco, we saw that it rose by 62% For the quarter, that's the chart that you can see right there, the 90-day share price tracker. It rose by 62% with explosive momentum in the final month. It demonstrated strong and consistent upward momentum, particularly from mid-September onwards. The share price climbed from 49 cents to 80 cents with a significant acceleration in the last 2 months, in the last 2 weeks, so to speak, underscoring strong investor confidence since it released its financials recently. Simbisa was up by 29%, showing resilience and volatility. As you can see, Simbisa experienced some notable fluctuations, including a sharp dip in mid-September, but recovered strongly to close the period at 29% higher. This performance highlights its resilience and recovery capability in a dynamic market, finishing at 40 cents from around 30.9 cents. But Delta, which is one of our blue chips on the ZSE, it gained by 6% in a period of tight liquidity for its SIG price, which confined Delta's movements to a narrow band and made it the least volatile counter, a notable step change in the early August, so it stabilized at a higher level, highlighting its defensive nature. Meanwhile, looking at Econet, it was up by 23% with periods of significant volatility. Econet's journey was more volatile, featuring a strong rally in July, another peak in late September. Its price movements often reflected, of course, some specific market segments or company-specific news, but it maintained a solid overall upward trend for the quarter. Padenga, it surged by 92%. It was the top performer, and currently as it stands, is the biggest counter on the VFX by market cap, and one of the counters that we're going to look at as we are unpacking our financials. Now, let's look at our last slide as we conclude this first segment. On the ZSE, the top 5 counters right there, as you can see, these rarely changes. The regular interchanges often take place from the 6th position going downwards. And on the VFX, Padenga is currently the biggest counter, like I said. But as you can see on the chart, their market caps with Inscom, they are of the same range. That's why both of these counters keep interchanging on the first and the second position, and sometimes being replaced by Westprop. Here's our outlook for both the ZSE and the VFX for this current week, this month, and even this quarter. Activity on the ZSE is likely to be driven by the usual heavyweights, the top 5 by market cap, led by Delta and Econet. However, on the other counters, activity is likely to be minimal, driven by retail investor participation, as opposed to institutional investor participation, right? And especially activity that we are likely to see in retail investor participation, these are the counters that have recently released their financials. And just for the benefit of you, some of our audience, for you to catch up, some of the counters that released their financials, the likes of Dairyboard, Tenel, BAT, Unifreight, ProPlastics, NTS, Fidelity Life Assurance, FMP, FML, ZSE Holdings, and banks like CBZ, NMB, and FCB Holdings. And on the VFX, we saw Kavango Resources releasing its half-year financials, Zimplo, Exia, Insco, Simbisa, and also FCB. So on the VFX, we are likely to see the same momentum, albeit at reduced upside potential, as we have seen that uptrend in the third quarter. That's all that we have on the first segment. Thank you for tuning in, and catch you from the other side. Welcome to our second segment, where we unpick published financials or listed counters. Today we are going to look at OK Zimbabwe full year financial results for the period ending March 2025, as well as look at Padenga's half year financials for the period ending June 2025. For OK Zimbabwe, the story has been in the headlines of how the counter has been struggling, withstanding stiff competition in the informal sector, suppliers demanding USD payments, right, and experiencing store closures throughout the country, right. And also for Padenga, we've seen there's been a gold rush on the international markets, and Padenga being one of the gold producers, we've seen its share price also being on an uptrend. Some of the things that we're looking at that we covered in the first segment. So we're going to deep dive into these financials, and today I'm seated with my fellow analysts which are competent, which are going to share some of their views, and as we unpack these, I'm sure you probably glean 1 or 2 pointers right there. So without proceeding further, allow me to welcome my guest for today. I'm joined by Ian Banda and Tapiwa Kusereka. Tapiwa and Ian, welcome on subject.
Thank you.
Thank you.
Okay, so let's dive into it. Let's start by looking at this retail player, OK Zimbabwe, right? We saw this counter experiencing a 53% decline in its top line revenue. And in the report, it specified that they actually transitioned its functional currency from ZWL to USD. That's in April 2024. And that's the same period that we saw the RBZ, introducing the new currency, the ZIG, which was fairly stable, I think, in the first quarter, but in the second quarter, approaching the half year, as of September, it was devalued. And the report specified that the devaluation was caused basically due to scarcity of USD, right? And that led to a surge in the parallel rate, and suppliers would then demand USD. So perhaps now the question that I just want to understand from you, how significant is this change from ZWL to USD in terms of the functional currency, and to what extent does this distort the year-on-year comparability, since we have seen that there is a 53% decline in the top line? I'll just freely float the question. Maybe perhaps Tapiwa, you can firstly answer, and then we can move to Ian.
Okay, thank you. The transition in terms of functional currency for the group in 2024 is a substantial accounting change which distorts year-on-year comparability of financial numbers for OK. Because if we check correctly, the transition from ZWL using International Accounting Standard 21 from hyperinflationary figure to United States dollar, which is a little bit stable. And I believe now those converted numbers are not real US denominated transaction. So there is a probability of a understatement or overstatement of figures, because the group used a different internal conversion rate to convert those numbers. So there is a probability of a distortion in terms of values, in terms of financial figures for the companies. So in terms of comparing the previous period with the current period, due to those distortions for the analyst, it's quite difficult. But maybe the investors, they might focus on volumes and sales of the company.
And what's your picture in your sense as far as the volumes is concerned?
Yeah, it's quite challenging to comment on that one, given the position, the state of the group is for now.
Okay.
Yeah.
Okay, Ian, maybe you can share your thoughts.
I think it's a welcome move to actually change from hyperinflationary reporting to give us USD numbers. It makes our job quite easy as analysts to understand the financials, because Zimbabwe has been in a hyperinflationary period for quite a long time. So it has been really difficult to gauge or analyze the numbers. As analysts, we have resorted to actual common sizing, whereby we try to adjust those numbers into USD currency, something that we can easily understand. But then, like Tapio alluded, the problem now comes to actually know what exchange rate did they use. I'm of the view that in the formal retail sector, a lot of transactions have been happening in local currency compared to USD. USD is mainly in the informal sector. So I would like to believe, I'm just estimating here, that about 80% or 70% thereabout of their sales were in the local currency. So it's really difficult to then gauge, to actually say these are real USD numbers that they are giving us. And also in the report, management actually mentioned that these numbers do not really paint the real picture in terms of comparability with last year. But I think in accounting terms, yes, the picture may be overstated or estimated. But I believe that in terms, if we look at volumes, OK has been in a dire situation with the 53% decline in revenue, which they mentioned. I think it's also the same in terms of volumes. Volumes have severely declined. This is due to the liquidity crisis in the market, and also they have been facing stiff competition from the informal sector, and also the devaluation of the currency and the liquidity constraints OK was facing resulted in their suppliers now demanding payments upfront, or limiting or reducing the number of days they extended credit to OK. So OK now faced severe stockouts, exactly, and they couldn't have a variety of products in their shops. So I would like to believe that the volumes were also really down.
Okay. Now, on that same, maybe just a follow-up question as well. How sustainable is OK Zimbabwe's current operating model? Right? We've seen also the bottom line down. That's a loss of around 29.6 million.
Yes, 29.6 million.
Yeah. And suppliers demanding upfront USD payments. What should investors make as far as the going concern is concerned for this group?
Okay, thank you, Kuda, for such a thoughtful question. I think the retail business model, as we know it, in terms of OK, has been severely impacted because a retailer cannot really function without extended credit from its suppliers. So I think that raises a point of concern. But then we have to also take a look at the measures, the mitigating measures they tried to implement, the 20 million rights issue. Then they are looking to raise about 10.5 million from sell-off of asset disposal. So what this then does is the 20 million rights issue gave them some liquidity, which I think they will extend to their debtors, and in turn this will unlock some credit from their suppliers once they've managed to settle their debtors, and also give them, I think, a 12-month cushion in terms of working capital requirements as they try to stabilize the ship. So investors, I think, yes, the risk of OK going under is very significant, but I think we should give the OK board of directors a thumbs up, because they've brought in Mr. Willard Zirewa, the former CEO, and the CFO, also an experienced CFO, is also back. These guys have managed to sustain OK from the 2008-2009 era, which was really very difficult compared to this period which we are in. So I think the ship will be stabilized. I don't think there's really a lot of concern that OK will cease to be a going concern going forward.
Okay, thank you. So, Tapiwa, do you share the same sentiments? I've heard someone can ask, is there any need for concern as far as succession plan is concerned, as we have seen the board actually bringing back, like Ian has alluded, Mr. Zirewa, but someone might be concerned to say, why was there no somebody internally who could have filled his role? What's your sentiments right there? Do you share the same sentiments with Ian? And as far as succession plan is concerned, what's your view?
Yeah, I do believe that the return of the veteran with the clear memory of what the group can do is a wonderful move for the company, because they have a clear memory from the previous environment of hyperinflation, like what Ian mentioned. So I believe from that say, it means in the short run, the company or the group will be able to maintain stability, but the question remains the same. They need to have a clear succession plan for now, because in the long run, automatically they need to transition from these veterans to new blood. So I believe for now, the comeback of the veteran is a wonderful move in the short run. But in the long run, they need a succession plan, a very clear one.
Okay, thank you. Now, this is the last question for OK, and I'm also going to pose to both of you. The report mentioned about competition from the informal sector, right? And as far as the stability of the prior market premium is concerned, we've seen it being fairly stable from September. I mean, yes, even up to date, once the ZiG was devalued last year. But the report also mentioned about pricing distortions, right, from exchange controls. So what should OK Zim do to regain market share and regain, I mean, its margins that it has lost severely for the full year ending March? Maybe anyone of you can start.
No, okay, I'll start with that one. So I think for OK, first of all, I think they should focus on cost containment. I would like to actually say they did a good job in the previous year. We saw that overheads reduced by 51%, but more can be done. So for example, we saw that a lot of cost was going to generators to proper power. So I think they can put solar systems in place that will help to reduce the cost going to generators and auxiliary power. Then the other thing is I think they need to focus on improving their stocking levels. Have a variety of products in store that are competitive with the informal sector, and also implement a market-determined price. I think now the exchange controls have been loosened a little bit, and I think most retailers are now charging a marketively competitive rate. I think we see a rate of around 32 ZiG per each dollar, which is reflective of what's happening in the parallel market as well. So that's competitive for them. If their pricing matches the pricing strategy that is in the informal market, I think they will do well. And also, if you have a lot of products, it's very difficult for one to actually go to downtown or the tuck shops per se. There's hassle for parking and all that. But if you're OK store, which is close by to your place, has all the products you need, and the pricing is similar or almost competitive with the informal markets, I think they will regain their market share back, because I prefer to go to a store that is near me than do the hassle of driving into town, going to the tuck shops and so forth.
Okay, any additions?
Yeah, I think OK Zimbabwe should do something in terms of re-strategizing. If you look at their business model of running large stores, I think if they try to downsize and operate small stores, that one will help them in terms of cost containment and cost optimization. And I believe if they try to franchise in terms of other segment of their operation, that one will help them to contain cost, to remain in business, and to maintain going concern in their business, and to regain confidence from the suppliers, from the customers. I think if they try to implement those measures, they will do better in the coming year.
Okay, thank you, James. Now let's move to the VFX, particularly Padenga, which has been one of the counter, like I've said in the first segment, which has been on an uptrend, right? Particularly maybe due to the rallying gold prices. What's your overall sentiments of the performance of Padenga? We saw revenue was up by 38%, and the bottom line was also up by 186%. So I just want to get your sentiments for the performance of this gold producer for the half-year period. Yes, you can start.
Okay, thank you, Kuda. So I think the bullish gold price has been a significant factor in the almost 38% increase in revenue and the 186% increase in the bottom line. So if you look at their financials, Telagio, which is the mining arm of Padenga Holdings, contributes 94% to the top line to revenue. So if you then take that and you look at the gold price, I think year to date, around 14 October from the chart, as we can see, it was around 2,600 an ounce. That is 14 October 2024, 2,600 an ounce. And then you now come to 10 October 2025, you're looking at 4,000 an ounce. Yeah, that is a significant jump. So, and they also improved their volumes in their gold mining arm. their volumes were up, I think, by 7% to around 1,250 kgs. So that's what's propped up their financials. So I think Padenga is slowly moving from being to being a mining company. Yes, as opposed to the agribusiness segment, which we knew Padenga for in the prior years. Now it's more of a mining arm with just a significant stake in some agricultural business in terms of crocodile farming.
Interesting. So how does this position Padenga for the rest of the year?
I think with the uncertainties in the economy, we saw how the markets react to the news of Trump and their trade war with China. Many people are still going to go for gold as a safe haven, as opposed to fiat currency. So I think the gold price is still going to rally, but I think in the medium term, as we have reached 4,000, I think this is a psychological price where we are going to see most of market players will, I think, pause for a moment at the 4,000 mark, but I think there is potential going forward for us to breach 4,500 US dollars an ounce.
Okay. Tapiwa, let's talk about the crocodile business, right? In as much as it contributes power to the top line, but how has been the crocodile's key operations for the half year? And are there any signs of recovery post-COVID-19 in terms of the demand of the skin as well as its pricing as well?
Yeah, I believe in terms of growth, Padenga agribusiness is doing well and is on recovery stage, though is not yet hitting the prior peaks before COVID. But I believe in terms of the global trend, in terms of price, in terms of preference for the high-end market, especially France, the demand for leather is now high, and we are hoping that Padenga agribusiness is going to leverage on that, and we are going to see a much of a positive trajectory in terms of revenue growth generated from agribusiness. But for Padenga overall, their mainstream for revenue it's from gold and Dalaglio from that Eureka mine. And I believe they are doing well in terms of the overall business model in trying to diversify. So they are no longer relying on a Padenga agribusiness, they are now relying on mining, and which is a good thing for the company, and I believe is in a well position as they trailing Coimba, but leading a Caledonian mine. But they are doing well. If you check on in terms of investment, they are investing well, they are investing in power. Those things will maintain the sustainability of revenue growth for the entire
second half of the year.
Second half of the year.
Okay, interesting. Now we have seen that there has been an increased use of the USD, and there's been shifting of policies, right, in our local environment. Looking at Padenga, are there any specific issues that you can point at to say maybe issues to do with the exchange rate distortions or the issue to do with forex restriction? Because I'm sure, I mean, all of the counters initially they were not subject to the forex restriction, but it was, uplifted along the way. How has some of these affected Padenga, whether be it the earnings or the profitability, in your view?
Okay, thank you, Kuda. So the exchange rate has been fairly stable. I think we should commend the authorities for that. Post the September devaluation, we've seen that the ZWO has only depreciated by around 4% to date. So I think that's commendable. In terms of retention, so Padenga being a major gold producer and a major exporter of crocodile skins, it earns most of its revenue in USD. And recently we saw that the authorities actually increased the forex retention rate to 30%. So for a company like Padenga, which is heavily exposed to USD denominated debt, it means that around 30% of your revenue is now converted to local currency. And this lessens or puts pressure on the cash flow that you have to pay your debts. Then when you go back to the market, I'm not really sure if the interbank market is able to give you the forex as of when you need it. So at times then you have to take your local component to the parallel market to get forex to pay your foreign denominated debt, and you are getting a rate of 32 to 35. So I think this severely impacts Padenga's operations in terms of servicing its debt. So I think going forward, if the authorities can also try to meet halfway with the foreign currency earners, because we have to also take note that the economy is mainly dollarized at the moment. So I don't see any reason to increase the forex retention rate to 30%. And there's also been mentioned that the RBZ or the fiscal authorities have been actually failing to honor those local denominated retention, the local component of the forex retention. It hasn't been paid to the exporters in time. So that means that you have some revenue which you are not able to actually get for maybe a period of 30 to 90 days.
You touched on something that's very crucial that I think I can ask as well. I mean, primarily, looking at the past, Padenga relied heavily on debt to finance the expansion of its mining operations. So what's the current leverage position? And in your view, how manageable is it with its maybe current cash flows?
I think with their current cash flows, they're in a healthy cash flow position, as we saw that they managed to actually decrease a major component of their debt with the interest expense down 39%. That actually tells you that with the cash flows they've received, they've actually taken a bold step to actually say, let's reduce our debt level and put ourselves in a favorable gearing position going forward.
Okay. Yeah. Tap you up with the last question. The group specified about diversification and operational efficiency. In your view, what do you think are the key risks for Padenga in this second half of the year?
Yeah, I believe some of the key risks which will affect Padenga is emanating from maybe a policy risk, or like what was mentioned by Banda, especially emanating from retention issues. Okay. Yeah, I believe those effects are going to affect the liquidity position of a company, because if they, as it stands now, the group's financing cost are mainly denominated in United States dollars. So if they are going to earn revenue in a local currency, automatically they need to go to the black market to convert those money to United States dollar. And what I believe and what I feel, those effects is going to cause a liquidity pressure on the company in question. So those are some of the risks. And we also add in terms of exchange rate. Yeah, exchange rate is going to affect this company, especially in terms of when they try to convert those retention funds. So yeah.
Okay, thank you. So I'm picking that more of the risks that have got to do with Padenga, these are exogenous factors as opposed to endogenous factors. Well, gents, thank you so much for an interesting discussion. Those points that you've said were very enlightening. I'm sure some of our audience find it very helpful. So Ian and Tapio, thank you so much for joining me. I'm looking forward to having you even on the coming episodes. Thank you, gents, for joining us.
You're welcome. Thank you.
Okay. And for you, our viewers, thank you for tuning in. It's our pleasure. We're here to save you, and we're here to unpack whatever it is that you want us to unpack for you so that they make sense for you. Thank you so much for tuning in. That's all time we have for today. Until next time, keep your eyes on the markets. Bye for now.